A depression and a banking crisis in America might have just started. Because according to Axios, Silicon Valley Bank, the 16th largest bank in America, has now failed. And depositors are panicked, pulling money from the bank, causing a bank run. And the reason that this is happening is because the Federal Reserve is sucking money out of the system. The money supply is actually contracting right now. It's down 2% year over year, which is actually the first time in nearly 100 years that we've seen a money supply contraction. And actually the only other 4 times this has happened in US history where the money supply has contracted, we have had a depression. And before getting further into this video, everyone, where I'm going to kind of tell you guys how to prepare for a deflationary depression if it happens, I just want to say I understand that saying words like depression and banking crisis can sound alarmist. And I'm not trying to be alarmist here. I'm merely connecting the dots on the data that's available in the economy right now. And what's scaring me right now, and what should be scaring you in the economy, is that up until yesterday, when this banking crisis in Silicon Valley hit, no one was talking about this. No one was talking about the chances of a banking run, but now that's becoming a lot more obvious, and it should be, because one thing the Federal Reserve did when the pandemic started was they suspended reserve requirements. Typically, a bank is required to hold 10% of all of their deposits on hand, either at the bank or in a vault at the Fed. But when the pandemic started, because of how crazy that was, the Fed suspended the reserve requirement, and it is still suspended. So right now, banks are actually not required to hold cash on hand, which is how you get a bank run in a banking crisis. And ultimately, the way that this will impact the economy, if it plays out the way I think it will be through deflation. We're going to see, actually, contrary to the crazy inflation we're seeing right now, we're going to see a shortage of dollars and a shortage of cash in the system. And the bank run that started in Silicon Valley could happen to other banks around America. And that risk is one of the reasons why the banking stocks are down so much over the last 2 days, particularly a stock like First Republic Bank. They're one of the largest banks in America with nearly $200 billion in assets, and their stock is down 37% over the last 5 days. Investors are fearing that we could be seeing other bank runs, especially ones that are exposed to tech, because the tech industry is going down hard right now. And a lot of these startups and a lot of these companies, they need the cash. They're trying to pull it out of the bank right now. And because there's no reserve requirements, and because even when there are reserve requirements, banks only hold about 10%, the bank doesn't have the cash to fund those withdrawals. And that's ultimately what creates a banking crisis and a depression. Because if we go back to this graph that I showed you earlier on the change in money supply, we talked about how the money supply is contracting right now. Let's talk about the 4 previous times the money supply contracted. Once in the 1870s, it contracted by 2%. This was called the long depression of the 1870s. The unemployment rate went to double digits. We had big deflation. Then it happened again in the 1890s, in the panic of the 1890s, which was another depression where the unemployment rate went as potentially as high as 18%. Then we had the depression of 1921, where the money supply contracted by 2%, and we had the unemployment rate go over 10%. And then, of course, we had the Great Depression. In all of these instances, we had bank runs, banking crises, high unemployment, and deflation, which means, I think in 2023 and 2024, the odds of that are increasing significantly. And I'm not going to say it's a guarantee, but when you look at the chessboard and how the pieces are moving, you see the banking crisis right now in Silicon Valley. You see the money supply contraction going on. You see the Fed aggressively hiking interest rates. You see the initial signs of a recession in numerous different sectors like the real estate market. I mean, folks, the writing is kind of on the wall here for a big problem to come about in 2023. And the way that I'm preparing for this possibility that there's a deflationary depression coming is by holding cash. And when I say holding cash, I don't mean having my cash in a bank. Because clearly, as Silicon Valley Bank just showed us, having the cash in a bank isn't good if the bank isn't solvent and everyone else is trying to take it out of the bank. So I think it's important, just as a valve of safety, to have some money in cash on you, in your house, in a safe place. Maybe it's $1,000, maybe it's $2,000, but enough money that if, excuse my language, hits the fan, you will be able to survive for a couple weeks, for a month, until inevitably, if this happens, the Federal Reserve and the government will come to the rescue. They're going to reverse everything they're doing and try to do another bailout and print money. But in the interim, it could get messy. And there's a chance at some point later this year, you might go to your bank and maybe you can't take the money out, or maybe it'll actually be something more subtle. Because let me tell you a story about something I experienced actually a couple months ago, folks. I was trying to transfer money from my business account for reventure consulting to my personal bank account, and it was a decent sum of money. And when I initiated the transfer, my bank blocked it. They didn't let me transfer the money from my business account to my personal account. And I thought, whoa, that was weird. Let me get on the phone with them and try to talk to them about it. And then literally over multiple days, I wasn't able to transfer the money because I kept running into these like security identification things that weren't working. And then when I talked to a real person at the bank, they said, I can't help you because the security identification isn't working. And I started getting the sense that my bank did not want to let me take the money out and transfer it to the other bank. And that was like a wake-up call. I was like, wait a minute. I don't actually have this money. Like, it is mine technically, but it's in the bank. And until it's in my hands or in an asset that I control, I don't really own it. Like, not figuratively. Like, I don't really have access to it. And fortunately, eventually, I was able to make that money transfer. But that situation just kind of tipped me off to this idea. And, inevitably, some people are going to write it off. I'm already seeing people say things like, this isn't a big deal. This is just a tech bank in California that had exposure to crypto and tech startups. Like, that's not going to happen everywhere else. In Yahoo Finance, they underscore this point. They say the biggest US banks are now much stronger than they were in the lead up to the last big banking crisis in '08, in part because regulators have forced them to hold more capital and survive stress tests. And as a result, they have more diverse funding and thus more options during challenging times. And so maybe this won't be something that spreads to like all the banks in America and it's like a massive panic like the Great Depression. But like, there's another thing you got to think about here, folks. And that's the fact that not only is the Fed contracting the money supply through quantitative tightening, they're also increasing interest rates. And the more that they increase interest rates and the yield on treasuries, the more they're incentivizing bank depositors and people who are saving money to pull their money from the banks and to put it in US treasuries. It was a 5% return on a 1-year US treasury. Now it's gone down to like 4.7, 4.8, but that's still much better than you can get in a bank in your savings account. So that's something, the shift of depositors away from the banks and into the treasuries, that's something that could destabilize the system even more. The thing to understand, folks, is like we're in unprecedented times with all the stimulus and money printing that occurred during the pandemic, and then the complete reversal in that's occurring right now. Like, we have never really seen that in peacetime. We've seen that historically in wars before, that level of like money printing and then contraction, but in peacetime, that's new. And what's also new is the fact that we have so much debt as a country. Right now, the federal debt to GDP ratio is 103%. There's a $27 trillion debt bubble here in the US government, and that's more than the GDP. That's more than our economy produces in a year. You could see that's double the long-term average of the debt to GDP ratio. And basically, since the Great Recession in 08-09, the government has just been borrowing money like a drunken sailor. And that government borrowing and the infusion of that money into the economy through stimulus checks and assistance has kind of propped the economy up and helped create this inflation. But I'm seeing a scenario now with rising interest rates that makes this government debt burden not so feasible. I mean, when short-term interest rates were 0 2 years ago, the government could borrow a lot of money and they didn't really have to pay much in interest. But now with short-term interest rates of 4 or 5%, the government's burden on paying interest is going to go up a lot, and that's going to constrain their ability to take out more debt, which is something that could cause the economy to go south. Because without that continued infusion of debt hitting the US economy, consumers are going to run out of money. I mean, they're already running out of money and having to resort to their credit cards, and they have a record low personal savings rate. So that's concerning, is that we have so much debt. That wasn't a situation that really existed in the same way in the 1920s, let's say, when we had the previous depression, or even in the 1970s when we had the last big inflation. our government debt was very low. But of course, it's a very different situation today with us hitting up against the debt ceiling constantly. And you've heard this in the news, right? You see all these articles about, the debt ceiling, and conservatives are demanding cuts in spending. A lot of people are saying we could default on the debt. And I don't know, folks. I mean, maybe that's something that could happen. Like, it hasn't happened. It seems like each time Congress and the president, they always strike a deal to raise the debt ceiling. But we are in kind of a different time right now with how high the debt is, how bad inflation has been. Interest rates are surging from a very low level. The economy is in the beginning stages of a recession. Like, there's a lot of new variables here that cause me to believe that we're going to see problems with the US debt. And either maybe we'll default on the debt, or like we're going to cut spending and raise taxes significantly. It's going to be one of those two things, because the current situation isn't going to last, and either outcome is really not very good for the economy. So what do you do out there with this information if you're a home buyer? Well, folks, one thing you would definitely not want to do before a deflationary depression where the government cuts spending and banks are having a crisis, you would not want to take out a mortgage, because in a deflationary depression, home prices will be going down, and down by a lot. And that can lead to a lot of people being underwater on their mortgages. Now, I know a lot of people are going to watch this video and are going to say that I'm crazy, and that we haven't had a banking crisis in 90 years, and there's no way this happens. And they're going to say also that the government is just going to come to the rescue and save the day, which probably will happen at some point. I mean, the government isn't just going to let the banking system completely collapse. They're not going to let depression go unanswered. But the point is, like, with where the Fed is right now, Jerome Powell and the Fed, they're really between a rock and a hard place, because inflation is still a big problem. So the Fed can't really pivot away from fighting inflation until inflation comes down enough, even though we're seeing all of these big warning signs that there's huge deflationary problems ahead in the US economy. And so in the near term, I'm not expecting a government bailout. I'm expecting the Fed to keep hiking and to keep taking money out of the system through quantitative tightening. And so long as, Republicans control Congress while Biden is president, I do not think we're going to see a fiscal bailout either. That is, until things get bad enough. If the unemployment rate goes from 3.6% to 10%, then yeah, everyone will be on board to bail things out. But I suspect there's going to be this interim period where it's not going to happen. And that interim period could be very problematic for someone who is over leveraged on debt, doesn't have cash on hand, and really is struggling to meet their expenses. When you look at what's happening with the banking crisis in Silicon Valley, the contraction in the money supply, the Fed aggressively hiking interest rates, all the other warning signs of a recession like a collapsing housing market, like, this is a definite possibility. Maybe it's not a likely possibility. Maybe it's not even a 30% possibility, but it's one that should be considered. I think exercising just some basic prudence and caution and just having a bit more cash on hand and maybe some gold, that's probably something that's just a good idea in general in times like this.